Hello class. This video is meant to help you to better understand the fundamentals of the balance sheet, the income statement, and the statement of cash flows, and how they fit together. Basically, we have the balance sheet, and the balance sheet consists of three things really: assets, liabilities, and equity. The basic formula for the balance sheet is that assets equals liabilities plus equity. Assets are what you have. Liabilities are what creditors own of what you have, and equity is what you own. So for example, let's say that you have a car, and that car cost $10,000. You might have acquired a car loan for $8,000, and you invested in the car $2,000. So in essence, your own personal balance sheet would show that you have $2,000 worth of ownership personally in your vehicle, and $8,000 worth of that vehicle is still owned by creditors. So the balance sheet basically shows you how you financed that car as well, through borrowing and through investment. All balance sheets are identical. The key thing is for a company, equity is composed of two pieces. The first piece is investment. The second piece is earnings. Which brings us now to the income statement. The income statement shows us performance over time. The balance sheet, in essence, is a static document. It shows what we have at a particular point in time. So oftentimes when we're evaluating performance over time, we will look at the balance sheet before performance and the balance sheet after performance to see whether or not we've increased what we have and whether or not we have also increased what we own of what we have, and to consider the possibilities for financing expansions in what we are doing with regard to our business model. So the income statement basically is made up of revenue, and revenue comes from the sales of the products and services that we're selling. And the cost of goods sold represents the cost of the products that we're selling if we have products to sell. If we don't have products to sell and it's a service company, then we wouldn't have cost of goods sold or gross margin. But in the case that we do have products that we're selling, then we would put in a line item for cost of goods sold in order to determine what is the gross margin. And the gross margin basically lets us know what we have to work with in terms of funding or earnings before operating expenses. So that we can evaluate what we need to do in order to generate the sale of these products, in order to generate that revenue. Operating expenses we typically will break into three categories: expenses from operations, expenses associated with sales and marketing, and expenses associated with everything else. We call those general and administrative expenses in order to derive what our net income is, or what our performance is during the period. That performance during the period is correlated to the balance sheet in terms of the earnings that we retain from that performance. We may end up paying out some of these earnings in terms of taxes or dividends for other purposes. But whatever we retain of those earnings is incorporated into our balance sheet because it becomes equity, in essence, that we have in our business. And ultimately, we want our business to be able to generate earnings that will enable us to borrow money to buy more assets to continue to expand our business rather than to acquire it just from investment. If we have a business that doesn't generate earnings, then there will be a limitation point where investors will stop investing, because their anticipation is that their investment is there in order to help to establish the borrowing of money so that collectively these funds can be used to purchase assets to start your business. but that ultimately the business itself will ultimately be yielding earnings that will enable the organization to utilize its balance sheet more effectively over time to expand the business and create a self-sustaining entity. The statement of cash flows relates to the balance sheet also. The balance sheet shows a cash position within its asset column. It shows how much cash that the organization has on hand. We're interested in understanding how cash was managed during the performance period. So we'll usually look at a balance sheet before the performance period and a balance sheet after the performance period in order to determine how we've performed and how we utilized cash. So our beginning cash position is the pre-performance balance sheet's cash position. Our ending cash position is the post-balance sheet's ending cash position. And within that period of performance, we want to understand how the business utilized its cash. In essence, its cash receipts and cash disbursements, or sources and uses of cash, and we usually categorize those into three activities on the statement of cash flows. We categorize them into operating activities associated with performance, we separate them into investing activities that are associated with the purchase and sale of property, plant, and equipment, and we associate it with financing activities, which has to do with our borrowing and investing activities. The core formula for the statement of cash flows really is beginning cash plus cash receipts minus cash disbursements equals ending cash. In essence, the statement of cash flows reflects something like a checkbook. Whereas the income statement shows performance over time. It doesn't necessarily show the receipt and disbursement of cash. That is based on the terms associated with how the organization functions in association with collections from customers, payments to vendors, and so on and so forth. But what the income statement shows is it shows performance in which we attempt to match expenses during the period to the revenues generated during that period of time. When we think about expenses, an important way to think about that is that we are, in essence, acquiring assets. And those assets can be property, plant, equipment, furniture and fixtures, computers, and so on and so forth, but also inventory that we will use during the operating period, the performance period, in order to generate revenue. One of the items that's in the income statement column that we cannot put on our balance sheet is people. But we show the utilization of that resource in terms of wages. I hope this has helped your understanding of the balance sheet, the income statement, and the statement of cash flows.